Welcome back, everybody. So today we are going to be talking about the stock market, the bond market, and everything else in between. Now, first of all, I just want to apologize. I have been very, very sick over the past couple of days. The executive summary is do not eat the chicken if you come to Bali or Indonesia. I basically stuck to that rule for 5 months. I thought I would take a risk, and that risk did not pay off. So do not eat the chicken in Bali or Indonesia in general. Now, let's talk about the stock market. Now, again, I am probably receiving well in excess of 800 to 1,000 direct messages every single day, just in relation to what is going on in the bond market, the stock market, blah, 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 blah. What's going on in Spain? What's going on in Portugal? Oh my God, property prices in London, property prices in Canada, property prices, it just keeps going on and on and on. And the thing is, it is a little bit difficult to reply to absolutely everybody, but I do try and do it. But basically, what I want to talk about is it doesn't really matter. And the reason why I say it doesn't really matter is because you need to start looking at the bigger picture. The bigger picture is that China is under a significant amount of stress. And I know I keep saying this, but they are in so much stress. And you can see this in the CNY, CNH spread. When that spread gets to about 2.2, you see China intervene by basically selling US treasuries, gold, or whatever to stabilize their own economy. Now, yesterday, we saw that spread basically elevated above 2, and that would kind of imply that China is in a significant amount of stress. And I would anticipate that they are going to be forced to sell something relatively soon. And, the stock market keeps going up. A lot of bears get frustrated. They want to jump on some news and, get confirmation bias. Well, the reason why the stock market needs to go down now is because of ABC, X, Y, and Z. And there's a lot of bulls who are very, very happy. Now, what I would say is that I speak to quite a lot of family offices and hedge funds, and they are quite pessimistic on the overall markets in general. Typically, it's a lot of retail who are very optimistic on the stock market. They obviously are buying the dip, etc., etc. And, who's going to be right? Who knows? But the reason why I keep saying that it doesn't really matter is because the bond market really does matter. The CPI print, the GDP numbers, blah, 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 to me is absolute nonsense. And the reason why it's nonsense is because if you have $36 trillion, $37 trillion of debt, of which 40% of that debt needs to roll over onto 5% interest rates, you do not care about anything else apart from getting the interest rates down. Now, before I start receiving all of these comments about, oh, well, the Fed can just cut, the Fed can just cut, the Fed can't just cut. And the reason why the Fed can't just cut is because the Fed only controls the short end of the yield curve. It doesn't necessarily control the long end. The long end is dictated by the markets. And at the moment, because a lot of people are in a lot of stress, they are forced to liquidate their assets, what is US Treasury bills, gold, or whatever. And obviously, as a result, you can start to see the US Treasury bills start to tick up. And this is the reason why we have the US bonds starting to spike, is because people are forced to liquidate. And again, some people keep saying to me, well, it's because nobody trusts the US. Well, who do they trust? And this is, again, I was having this kind of conversation with somebody privately in my direct messages. And again, I was just kind of thinking, why am I wasting my time having these conversations one-on-one, arguing about this and that? And he was basically saying that China is moving all of their assets to Switzerland. And I was just like, what are you even on about? Like, where are you getting this data from? And he's just like, well, because the Swiss franc is getting a bid. And I'm just like, what? Is that it? That's literally it. And this is the thing. It's like everyone's trying to grasp and look at these small, minute data points and basically draw the lines and basically say, well, the reason why we're going to go down is because of this. The reason why we're going to go up is because of this. And the reason why I keep talking about the bond market is because having rates this high and you're in that much debt is fiscally irresponsible. It's absolutely mental. And you need to bring the rates down. And the only way you bring the rates down is basically by crashing the stock market. You need to drive people back into US treasuries. But first of all, you need to destabilize a lot of these economies. And if that means that you throw, let's say, a large bank in the US under the bus for basically saving the trust in the United States dollar or the United States financial system, then so be it. And everybody keeps saying, well, the US has lost its reserve footing, the US has lost this, the US has lost that, blah, 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 blah. And again, I would reiterate that that is not the case, because Majority of trade is done in US dollars. And let me just touch on the deficit. And the reason why a deficit can be seen as good is because you are basically distributing the United States dollar around the world to obviously do trade. And at the moment, there's a lot of people who keep saying, well, the US has lost its position. And I would just say, well, where else are you going to put your money? Are you going to put your money into the Chinese stock market? Do you really trust the Chinese stock market and how they do their accounting? Do you really trust it? Do you really trust the European stock market? Is there much innovation there? If you are going to raise capital in the UK or in Europe, you are not going to raise it in the markets. You are going to get better rates and more appetite in the US markets than you are anywhere else in the world. And this is the reason why people go to the United States to raise money, is because it has the best financial markets globally. So this whole argument that the US has lost its footing, blah, 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 I don't think that is the case. And like I keep saying, the reason why I am very, very passionate about the bond market and why the yields need to come down is because of the national debt. I don't really see how they can get out of this mess at 5% interest rates. And you cannot necessarily be doing any manufacturing in the United States at 5% interest rates. You can't do anything. So, you know, they need to bring the stock market down. And that is what I am currently assessing. And what I do want to say is that they could theoretically get out of this mess by printing money. Now, again, it just depends on what direction they're going to take it in, because whatever direction you take it in, it's going to be painful, whatever direction, you know. So, for example, let's say you print money to get out of this situation. By printing money to get out of this situation, you are going to create inflation, and it is going to look fiscally irresponsible. So you are basically going to blow up your entire bond market, you know. And whether or not people actually go back into the bond market is going to be up for debate. But what you could do is you could bring down the stock market, what then would drive people back into US Treasury bills. Now, again, because we have a lot of headwinds, these headwinds could be AI. So AI is like eating white collar jobs. If you like software development, lawyers, basically anybody behind a computer, consultancy, anything like that. So you have a lot of price compression, wage compression on that side of things. Then obviously, if you started to print money, you would have inflation. So you would have price compression and inflation, what would kind of lead to stagflation, what you don't really want. So if you are really going to help the man on the street, you theoretically need to bring the interest rates down, and you need to bring asset prices down. So how would you do that? You would basically bring down the stock market on all asset prices, what then would push people back into the treasury market, what then would allow you to refinance 40% of the national debt. And then you could kind of build manufacturing and do everything else what you want to do in the United States at cheap money. So it would kind of work better. But again, it's like, it's I don't know, it's a little bit, I would say, frustrating, because you have all of these, let's say, moving parts, really. So this is how I am currently assessing it. I can still see a significant amount of financial stress in Asia, in currency markets, in the bond market. And again, because everyone's seeing the stock market go up because of the anticipation that this trade war has ended. And it's not ended, has it? It's a pause for 90 days. And this can change like this. One tweet, everything changes. One tweet, everything changes. And, you know, everyone's getting very, very excited. I can imagine that if rates start to go to, let's say, 5.5%, what would be mental, I'm assuming you will start to see these tweets come out, what would basically say, we are going to negotiate a deal with China, blah, 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 and we think that we are going to put tariffs back to 120, blah, 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 blah. And this is the thing, right? It's like, if the rates, the tariff rates were at 120%, just imagine what would be going on in India and Pakistan at the moment. And, you know, it's, because again, the US cannot finance another war. It would be in, obviously, the Middle East, it would be in Eastern Europe, and then it would be in India and Pakistan. I mean, it would just be absolutely insane. It would cost you too much money to finance everything. And especially when you have all of this bloat, I just don't think it would be in the best interest of the United States to get into another war. And that's why I think that the de-escalation between Pakistan and India was a result of the trade deal talks with China. So yeah, so the executive summary is, I think that these rates are going to be coming down sooner rather than later, because they cannot afford, for businesses, small businesses, large businesses, the United States government, individuals, absolutely everybody cannot afford 5% interest rates, because everybody is significantly indebted. You can see this in credit card delinquencies. You can see this in card payments as well. Well, car loan delinquencies. So again, like, this is what I keep saying, is like, just because the stock market is going up, what to do? Like, it doesn't solve the bond market. The bond market is where everything's at. The reason why the stock market can be going up is because of a multitude of different reasons. Because of short squeezes, because of gamma squeezes, because of options, because of, you know, like, you could list a million different options. But the reason why I keep reiterating why the bond market is so important is because it basically dictates the cost of money going forward. And I cannot see the United States government paying 5% interest rates on its national debt. And, you know, that is just where my head is currently at. And again, addressing the deficit, having a deficit can be seen as good, because ultimately you are distributing your United States dollar around the world. Then what these countries do with their surplus is that they reinvest it back into your markets. And you can see this with the, obviously, price to earnings ratio across a multitude of different types of stock markets. And, you know, obviously the US has the highest price to earnings ratios across the world. And this is typically because the United States obviously distributes its dollars globally. Let's say distributes it to Europe, distributes it to China, and then people in China, people in Europe invest in United States assets, companies, etc. And this is why you have the stock market going up or getting a large bid, because everybody is propping up the market, because these dollars get recycled back into the United States. Now, something else, what I think a lot of people don't really pay attention to, is the euro dollar system. Now, the euro dollar system, what is that? That is basically the dollars what are not necessarily accounted for in the United States banking system. So if there's a squeeze on dollars anywhere globally, or there's a margin call or whatever, you start to see a lot of fragility in this euro dollar system. I'll put it on the screen now in terms of what it actually is. But it's quite a large system. What is, you know, there's, like I keep saying, there's a lot of fragility in this whole debt economy. And when you have interest rates at 5%, things start to break. And I think things possibly could start to break even more in Japan first. I think you're going to start to see a lot of credit risk. And like I was saying, over the past couple of weeks, I've been in Malaysia, obviously speaking to people, and Singapore. And they are not necessarily having the best of times from a credit perspective. But again, take that with a pinch of salt. Now, what is the executive summary of all of this? I think the question is, who can endure the most pain financially? Is that going to be the United States, or is that going to be these other countries? And obviously you can start to see this playing out in the bond market. And, you know, how are the rates going to come down? I am anticipating something has to happen. I'm anticipating let's say a quick snap or a liquidity squeeze, where kind of all assets start to come down, and then people start to transition into the US bond market, what ultimately brings the yields down, and obviously all asset prices and everything else down as a result, because that is how you bring asset prices down, cost of capital down, and everything else down, and then obviously you can build America back, blah, 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 blah. But at the moment, obviously things are starting to spike. So the yields are spiking, the stock market is going up, and I think the stock market is probably going to go down. I think the probability of it going down is higher than it going up, but you know, it's very, very difficult to forecast, right? Because there could be a lot of people who are significantly short, and as the stock market keeps going up, a lot of these shorts are squeezed, and they are forced to cover their positions, what obviously would send the stock market up even higher. So yeah, it is a little bit tricky to kind of assess. So yeah, so that is my overall assessment. I think that the rates will come down sooner rather than later. I know it's very, very frustrating if you are a bear. I know it can be obviously very exciting if you're a bull. But yeah, I can't see the United States refinancing its debt on 5% interest rates. And that is the executive summary. But anyway, to the 4 people who keep on supporting me, I hope you're having a lovely day, and take care. Bye-bye.